So we recently got the question, how important is the IRR, which is the internal rate of return? And in short, my answer is it is very important. It is really a reflection of the net cash value and net death, and net death benefit performance. Think of it this way. When I open a whole life insurance policy, what do I have with that policy? I have a guaranteed rate of 4%. I have a surplus in addition to it. Maybe the company pays a total gross dividend rate of, call it 5 or 6%, whatever the dividend rate is. Keep in mind, I use the term gross. When I see the guaranteed rate, when I see a total dividend rate, that is always a gross rate that is applied to my cash value, but it's applied after the insurance company's cost of insurance, their mortality charges, any PUA fees, all that good stuff that actually supports, call it my purchase of the life insurance policy, the death benefit. So if I am interested in the cash value, I'm looking at depositing premiums into a policy because I want to grow the cash value. I want to better understand that. I say, okay, I see the dividend rate, but what's my net cash value grow to? Like, what's the net return or net internal rate of return? What is it actually growing by? Well, the IRR will tell you that. It's a nice reflection to see how early does the policy break even and what produces the strongest long-term cash value. Now, some things to look at when it comes to the internal rate of return is we have both annual IRR and average IRR. Why I like to make a distinction between the two is annual IRR would reflect what I'm earning each year. For example, if you have a mutual fund account and you earned 8% in 2020, you're going to state, I earned 8% this year, or last year I earned 8% on my investments. Now, if over a 20-year span, some years you earned 8%, some years you lost 100%, whatever it might be, you had negative hits, ups and downs and such, you then, over that 20-year span, would like to look at, or would want to look at the average IRR. So the annual IRR represents what I am earning on my policy, cash value death benefit performance, on a specific year, whereas the average IRR takes collectively all years. So if I'm looking at a policy over 5 years, say I've paid in $100,000 and I have $100,000, let's say I'm breaking even year 5, dollar for dollar, my average IRR would be 0%. Because over 5 years, I get back what I pay in. That's my break-even point. See what I'm saying? Whereas the annual IRR, maybe year 4 to 5, I paid in $20,000 and it grew by $20,000 plus another $2,000 on top of that. So I'm getting money back in addition to what I'm paying in, so that on that specific year, I've produced a positive annual IRR. It can be a little bit complex. We're going to break this down with visuals and such. Now, a thing in this industry that's important to be aware of, because not enough attention is given here, and if you're subscribed to our membership program, you've seen a lot of case studies that we've made available on actual historical policies, breaking them down to see, hey, here's what was illustrated, but here's what actually happened. That's what I want to know. But when it comes to illustrated and actual IRR, this is important. You know, an illustration, whenever we look at a policy, is based off of typically the present dividend rates, and I can decide to run a custom guaranteed report as well. If I just want to see the internal rate of return, you can kind of call it a worst case scenario environment. But that will always be an illustration. An illustration might project, call it a 5% IRR, that would be my after-tax, my tax-free net return on a policy. Yet, in reality, it may be more or less. I'll tell you this, in the insurance industry, 98% of cases, the actual IRR is less than the illustrated. If you're looking at the non-guaranteed values, if you look at the guarantees, it's guaranteed, so you don't have to worry about that in that respect. Typically, you'll see most companies perform a little bit stronger than the guarantees. My point, though, is often when I look at a policy, I have illustrated and then I have actual performance. And we always talk about, right, 4 major mutual companies, properly designed policies. And the reason behind that is not because they show the best values on the illustration. There's other companies that project much stronger cash values than the 4 major mutual companies. What I like to look at, and I'll always ask insurance carriers for this, is actual performance. Can I see some historical performance that validates that you've consistently delivered strong cash values to consumers? Some do, some elect not to disclose that information. But let's get into some content here, some spreadsheets to kind of compare and contrast. So specifically, we're going to focus on the internal rate of return here. Let's make this a little bit bigger. Screen size good? Yeah, perfect. So we've got a 40-year-old male, and this is a illustration here, just a basic illustration. We've got the full detailed illustration and all the nuts and bolts in our membership program. But 40-year-old male, 1090 split, it's actually about a 991 with a term rider. And then this one is actually a 4159 split without a term rider. So we optimized that policy, each policy as much as we could with and without a term rider, because often we hear a lot of arguments as far as going with the higher base premium because it will potentially produce a stronger long-term IRR, which we found in reality, real performance, not projections based on any period of time, real performance, that's not true. The minimum premium policies always produce stronger net cash values. But here's what I want to look at. So I've got my average internal rate of return on cash value and my average internal rate of return on death benefit. Okay, I'm paying money in. Look at this. I'm negative up until year 5. At that point in time, I've paid in 20 times 5 is $100,000. I have $101,000. That's why I see just about 0.5% as far as my average IRR. I've broken even. Then I've got the internal rate of return on the death benefit as well. Over here, average IRR, when I break even, you see that go positive. Now this is the exact same company, health rating, individual, age, all that good stuff. And as time passes, this had a higher dividend or surplus payout, yet this produced a higher net internal rate of return. That's what I'm really interested in. And again, this is the average over time. So I'm at about 4.5%. With the higher base premium, I top out at 4.2%. It's interesting when you start to break policies down like this. So that's the average internal rate of return. Let's very quickly produce the annual here. What I also want to do is make this a little bit more transparent. I should have done this in advance. There we go. So the annual IRR, we've already got a formula for this created. So what we'll do here is plug it in. And it's going to be interesting when you take a look at this. So again, annual internal rate of return and average internal rate of return. Remember what the average represents? The average represents what I've earned over time. So I break even year 5. At that point, my average IRR has a positive yield over 10 years. I paid in a total of $200,000. I have $238,000. That's the average internal rate of return. Hey, what did you earn over the past 10 years? A financial advisor might ask. 3.15%. What did you earn in year 10? 4.5%, right? Just like one states, hey, I earned 5% in my mutual fund account last year, or in my 5% Fantasy World bank account, whatever it might be. Well, here we go. What am I earning each year? And what am I averaging out? Good to be aware of those. I mean, really what you could also look at if you're not into crunching the internal rates of return and seeing how to maximize cash value is just look at the cash value columns, which one produces more cash at the end of the day. So it's good stuff to look at, kind of as a preview if you are not subscribed to our membership program. Well, these are the guarantees where more or less we see the exact same thing without the IRR study, but significantly more cash value on the minimum premium example. Let's plug it in actually. This is not the treat I was just referring to, but that's all right. Interesting how it works, isn't it? But what I wanted to touch on here is a case study. So where we talk about illustrated performance and then actual internal rate of return, here we go. So here's a policy that was issued in 2014, started with a lump sum of money, now just looking to pay the minimum premium, what he has in cash value, how much he's growing each year, but the actual internal rate of return based off of the company's present 2020 dividend rate. We did a guaranteed rate study on this. Point being, we always like to look at both. In any event, I hope you enjoyed this material. More to come in the future, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.